Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets.
Let's talk about the speed with which we are watching this market deteriorate.
We're red everywhere, essentially, down by 4-5%.
We're down over 16%.
Dow at the same time has fallen about 18%.
The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
Two-year note yields went from 190 to 166 in the blink of an eye.
On the NASDAQ, everything and more has been completely wiped out.
It was the worst day on Wall Street since the crash of 1987.
From the financial capital of the world, the opening bell is going to ring in 5 seconds, and to be honest with you, we wish it wouldn't.
Traders here working the phone say a lot of their customers are freaked out, waiting to see how low the Dow will go. They're focused on the Dow, not so focused on OPEC. Yes, OPEC did cut production by 1.5 million barrels per day.
Really, you're seeing just broad-based declines across all of the major technology sectors. Apple's under pressure, Yahoo down 8.5%, Cisco 6.5%, Research in Motion 10%.
And we're not getting the bid wanted. We're not getting the stop trading, and we see where the buyers are. We're just, every day they're pounding it.
The heightened financial turmoil that we have experienced of late may well lengthen the period of weak economic performance and further increase the risk to growth.
Can't look at it after you buy it because it's so horrible.
But we've had an 8-day losing streak in the Dow that in percentage terms puts it on par, close to the loss suffered in that crash in 1987, close to that percentage loss those 2 days in 1929.
What started in America last year has now spread to every part of the world.
We're down 9% today. The Xetra DAX over in Frankfurt is down by 9%. The Paris market down by 9%. Austria, which was briefly suspended earlier on in the day, is down by nearly 11%.
This market is as volatile as you'll ever see.
Traders saying this is the craziest day they have ever seen in these markets. Veteran traders saying they've never seen anything like it. The movement in oil prices.
3-month annualized core inflation that is a lag. While we all look at market, look at what does the stock market do? It looks at market-oriented data. And that's what the Fed should be looking at.
I don't know that I've seen you this animated. You seem downright
I am very
angry
upset. Yes, I am. I'm afraid it's like a pendulum. They were way too easy, as I've told you and many others through 2020, 2021. And now, oh my God, we're going to be real tough guys until we crush the economy.
Will we see third quarter growth? Unfortunately, third quarter doesn't look too much better with estimates of growth close to zero. We'll see the first official estimate of Q3 GDP in late October. Now, this prompts to a technical discussion of how a recession isn't technically defined as 2 consecutive quarters of negative growth, thanks to the Biden administration. Almost all the time in recent decades, when the National Bureau of Economic Research has announced a recession, it has coincided with at least 2 quarters of negative economic growth. So there remains a debate as to whether the U.S. may already be in a recession since growth numbers are negative. Now, the job market. The most recent unemployment report had U.S. unemployment at 3.7 for August 2022. That's a low in absolute terms. In most recent cycles, unemployment hasn't managed to dip below 4%, so we're in good place compared to much in recent history. Unemployment has increased slightly in the most recent numbers, but that can be an early warning of a recession. Recession warnings. Other recession warnings are flashing too. The yield curve, which has a strong track record in forecasting recessions, is now inverted. So with many views as the all-important relationship between 3-month and 10-year rates have not been inverted yet. So the stock market, then the stock market is not showing much optimism. Of course, the stock market is volatile and reacts and maybe overreacts to many things, not merely the U.S. economy. Still, the current bear market suggests there may be economic problems ahead. With the Federal Reserve, with the most recent increase in interest rates, forecasts from Fed policymakers show many forecasting higher unemployment in 2023, and some forecasting negative growth too. Generally, Fed policymakers have said in recent speeches that the current policy of raising interest rates to fight inflation makes a good U.S. recession a possibility, but they won't go as far as predicting one directly. What to expect? However, there are clear signals that the U.S. may be facing a recession or already in one. However, it will be important to watch the U.S. job market, which so far is holding up reasonably well. Many signals suggest a U.S. recession is looming, but so far the U.S. economy and certainly the job market has held up better than many anticipated. So regardless, the U.S. economy is not showing particularly impressive or balanced growth currently, and the job markets may be the key metric buffering the U.S. economy for now from a broader dip in growth prospects.